Welcome back to The Explainer. I am so pumped to get into today's topic with you because we are looking at an absolute tectonic shift in the global technology landscape. The 2026 Indian IT market correction has been historically brutal. It's been driven by global macroeconomic headwinds and, honestly, a sudden, sheer panic over artificial intelligence. Today, we're going to use Wipro as our prime case study. We'll examine how legacy IT firms are fighting tooth and nail against AI disruption, what this actually means for their business models, and exactly how retail investors should navigate the fallout. Okay, let's dive into this. Our roadmap is pretty straightforward. We'll start with a macro shock, explore the battle between AI and legacy billing, unpack Wipro's lost decade and their recent strategic pivots, look at the cold, hard market technicals, and finally close out with some actionable portfolio risk management strategies.
Section 1. The Macro Shock. Interest rates and the $285 billion sell-off.
To really grasp what's happening to individual companies like Wipro, we first need to establish the sheer scale of this market crash. Just think about this number for a second. $285 billion, or nearly 2 lakh crore rupees. That is the staggering amount of market capitalization that was just wiped off the Indian IT sector in a single trading session back in February 2026. This wasn't some gradual slide. It was a total systemic shock.
So why did the bottom fall out so fast? While global macroeconomic pressures massively compounded the panic. We had stronger than expected U.S. jobs data, which ended up delaying hopes for Federal Reserve interest rate cuts. That kept borrowing costs high, forcing global enterprises to heavily slash their tech and outsourcing budgets just to combat persistent inflation and very real recession fears. Because of all this, we saw a massive capital reallocation. Institutional investors simply started pulling their money out of growth-oriented IT stocks, moving it straight into safer fixed-income assets like corporate bonds. But, the macro environment is really only half the story here.
Section 2. AI versus legacy billing, the structural threat of agentic AI.
See, the Indian IT sector has thrived for decades on what we call the linear headcount model. You charge clients by the developer hour for coding, testing, and maintenance. But suddenly, with new AI tools that can automate 30 to 40% of routine IT work, with way less human error, by the way, that entire model is under an existential threat. We are witnessing a rapid, aggressive shift in client demand. They are moving away from general IT services and demanding AI-powered outcomes. Clients want automated platforms entirely decoupled from human headcount.
And this brilliantly illustrates how unevenly this AI disruption impacted the sector. While large-cap IT firms fell by an average of 10 to 20%, we're using 15 here as a midpoint, the mid-caps dropped around 27%, and small caps completely crashed by 38% or more. Basically, the smaller the firm, the higher the sensitivity to demand slowdowns. But interestingly enough, certain mid-caps with really agile AI-first approaches actually started converting those capabilities into real-deal wins way faster than their larger peers.
Section 3. Wipro's lost decade, a turnaround case study. Now, what's really interesting here is the stark contrast when we zoom in on Wipro's specific corporate struggles. It makes this abstract threat of AI disruption incredibly tangible. Look at this gap over the last decade. Back in financial year 2016, Wipro actually had higher revenue than HCL Tech. Fast forward to 2026, and HCL Tech has nearly doubled Wipro's growth rate, boasting an 8.89% compound annual growth rate compared to Wipro's stagnant 3.62%. Wipro has slipped all the way to the number 4 spot in the industry, and that gap is only getting wider.
So how exactly did they get here? Honestly, it's a story of deep execution inconsistencies. Back in 2021, Wipro spent $1.45 billion acquiring the consulting firm Capco. The goal was to boost their banking, financial services, and insurance revenue, the BFSI sector. But that consulting to execution flywheel, it never took off. There were deep cultural mismatches and a massive inability to cross-sell services in a tightening market. This led BFSI to report negative growth in 4 of the last 6 years. Combine that with accelerating European client ramp downs, and Wipro was in desperate need of a change. Enter insider Srini Pallia as the new CEO in early 2026, who quickly managed to help secure a $1 billion mega deal with Olam's Mindsprint.
To perfectly summarize this leadership transition for the C-suite audience, Phil First from HFS Research hit the nail on the head. Srini has inherited an organization that had drifted into inconsistent execution. What we are seeing now is a more deliberate attempt to simplify around AI-native, platform-led services. So the million-dollar question is, can they actually execute this time?
Section 4. Strategic AI Pivots, comparing Wipro to industry heavyweights.
Let's look at the competitive landscape. Wipro is desperately trying to break out of that linear headcount trap. They're actively consolidating their consulting and business process services, launching Wipro Intelligence, and trying to productize their execution using reusable AI platforms. This entire platform-led approach is designed to win massive mega deals. But here's the core issue. Scaling these highly competitive vendor consolidation deals to improve top-line revenue while fiercely defending their profit margins in a depressed market is incredibly difficult.
So the crucial point is how this strategy stacks up against the true heavyweights. TCS is already out there reporting $2.3 billion in annualized AI revenue. They're launching their Hypervault platform and striking massive sovereign AI alliances with OpenAI and AMD. Infosys has managed to integrate its Topaz AI platform into 90% of its top 200 clients. Meanwhile, Wipro's specific AI revenues remain completely undisclosed. Its peers are rapidly proving that AI is a scalable business right now.
And they're proving it's profitable too. Despite the immense pressure on legacy billing and the heavy upfront costs of AI transformation, Infosys is maintaining a steady 20 to 22% adjusted EBIT margin guidance. The top competitors are successfully balancing the very real risks of AI disruption with solid, reliable profitability. Now, Wipro's operating margins are improving. They hit 17.2% recently, but they still have a lot of ground to make up.
Section 5. Market Technicals. Analyzing Wipro's bearish position.
If we look at this from a retail investor's perspective, the short-term picture is deeply bearish. Wipro is down over 30% on the one-year range and down 11% over the last 3 months alone. When you check out the technical indicators, both the Relative Strength Index, the RSI, and the MACD are displaying strong bearish momentum. The stock is trading right near its 52-week lows. Basically, the market is aggressively pricing in the uncertainty of whether or not they can actually pull off this turnaround.
Section 6. Portfolio Risk Management. Balancing the investor equation. To properly balance your portfolio risk in a chaotic environment like this, we first have to ask, is the AI fear overblown? Did the market completely overreact to the news from Anthropic and DeepSeek? Well, while AI absolutely threatens those legacy per-hour billing models, the industry estimates that AI-first services actually create a brand new $300 to $400 billion opportunity. The sector isn't dying, folks. It's just transforming.
But transformation always brings volatility, and that perfectly highlights the danger of concentration risk. If your entire portfolio is tied up in IT equities right now, you are fully exposed to every bump and bruise of this AI disruption. Retail investors must weigh the very real risk of further downside as legacy revenues compress against the long-term value of a massive recovery as these firms finally pivot to AI platform models.
To balance that risk, investors usually contrast the high risk-reward profile of long-term IT equities against safer fixed-income instruments. While IT equities offer significant growth potential if a turnaround like Wipro succeeds, they are highly volatile and heavily exposed to global tech spending cycles. On the flip side, allocating capital toward fixed income, like corporate bonds, provides stable, shielded returns that lower your overall portfolio risk during times of intense market panic.
Which leaves us with a really important question for you to consider. In this era of rapid AI disruption, will you wait out the high volatility IT recovery, or will you actively secure your portfolio with fixed income instruments today? It's a completely new landscape out there, and managing your risk is literally more critical than ever. Thank you so much for joining me on this explainer. I hope this helps clear up the complexities of the 2026 IT crash. Catch you next time.